Well, this week we're going to talk about long-lived assets and how they're handled in a record-keeping system, and and how they're expensed. And when I say words like that, that ought to be key to you on which of the financial statements this actually affects. It's an asset, so of course we ought to be thinking balance sheet. What kind of asset is it? Is it a current asset versus a fixed asset? How does it affect my equity accounts? Well, it's an expense, so that's an equity account on my balance sheet. And also, it's going to affect my income statement because it's an expense, okay? And we're going to talk about depreciating these particular kinds of assets that have a specialty to them. So what we want to talk about are those assets which have a useful life of more than 1 year. Of course, if they have less than 1 year, they're going to be in the current asset balance sheet. Okay. It's probably annoying to keep saying that, but I want you to kind of get that in your mind. Why we went over the balance sheet. Now we're getting into the weeds of the information that goes to these particular statements that are so important in evaluating and making decisions within a business. Okay, so hopefully you're following me along this path, and if you're not, then I need a phone call, right? Okay, so they're all the things that are bought, sold, traded, or exchanged much less frequently than current assets typically. Okay, so something should be coming to mind when we talk about those things. Okay, they're the factory. Okay, we always talk about in the cow-calf business, the cow is the factory. If we sell all the cows, then our business goes away. We're no longer a cow-calf producer. We have to move on to something else. And that is so much. If we're corporate America, if GM actually leaves their factory, they can no longer build cars. They're going to have to build another factory and put together all the resources in a different location possibly, and that sort of thing. And we have those kinds of options as well. But anyway, it's usually fairly large. The cost is not necessarily, but and so that we would not want to use up all the expense in 1 year. All right, so it's not an item like feed. It's not an item like seed or fertilizer or some of those types of expenditures that we would actually expense in that 1 year. They last longer. We might have a tractor that lasts 10 years, so that we wouldn't want to expense the total purchase of the tractor for management reasons over 1 year. We would want to expense it over the lifetime of that particular asset. So number 3, pretty much what I just said. All right. 4 is income tax treatment is different than operating expenses. Okay. Right now we're trying to evaluate. It's November 1st. We're trying to evaluate whether we expense out some of those long-term assets a little quicker so that we can save on our taxes in real time, in now time. Okay, so we're talking about actually keeping a set of books for management versus keeping them for income tax, and many people try to commingle those things, and I understand that on a practicality basis, but with the advent of computers and spreadsheets and that sort of thing, it's just not that much more difficulty to actually track those things a little bit separate. Okay, so another concept that comes into bearing is that, well, you have a market value and a book value, and market value is what any willing buyer would give you for that particular asset on a particular day or within a short period of time. And most of us inflate that value. I will tell you, caution, is that We don't take into consideration the sales expense of those particular items, the time involved to get them out there and to market them. And a market value is if you had to sell and you had to find a buyer, what would they pay you for those assets? So don't get into that trap. And I just say that it's a humanness of us that actually says, well, I saw over here where somebody sold it for this particular asset. Okay, well, it might be all true, it might even be made up, but be very conservative when you start establishing market values. And you're going to be asked to do that in your business career many times if you have to go in and refinance some particular loans and that sort of thing especially. Okay, and then when you sell, you're going to have to do that. And you're going to sell. You're going to sell parts, or you're going to sell the whole thing and that sort of thing. Book value is actually what we use for management. It's just the purchase price minus any of the depletion, deterioration that we've actually expensed over time. And we'll get into that, and we call it depreciation. All right? So the book value is a little bit different animal than the market value, and they may not track each other, but that's okay. Depreciation, then, it's an economic concept, it's an accounting concept, and it's a tax convention, okay? At least that's what the IRS likes to call it. So it's just that we manipulate our numbers a little bit different on a tax basis than we might in order to give us good analytics in order to make good management decisions, all right? And we keep the tax part of it separate. It's important. It's an important component, but it's something that we keep separate. We're going to have to keep a little bit different record-keeping system right alongside the other one in order to actually do this the most effectively. So depreciation describes how the cost of the long-lived asset should be charged over an expense to the business. Okay? Since the asset is long-lived and useful life will extend beyond 1 year, it should be spread over more than 1 year. Okay? Because you're getting more use out of that particular asset. That cow can produce a calf, depending on your terrain, from 5 to 15 years. So on a management depreciation schedule may look way different than what the IRS actually allows you to do. And you should use what you would use for your business. And then you can keep track of the taxes alongside of it. Okay? First off, let's get this cleared up right away. There are some non-depreciable assets. One of them typically is land. Okay? Now, the minerals and that sort of thing, we might deplete those. They might lose value as we extract them, or they could actually just lose value over time if they're less useful in our society and that sort of thing. But the land itself is, as an accounting and an economic basis, the principle is that land does not depreciate, and we don't depreciate it over time. Personal, they're personal. They're not business, so they're not depreciable within our business. Okay, non-business assets would be personal, right? Assets that have no basis. Okay, no basis in what? Okay, well, basis is also a description that we give for the book value. That is the depleted value of an asset. Assets that have no basis would be something we did not have any, we didn't trade for, we didn't purchase, and that sort of thing. What's some examples? Well, a gift is actually an item which we would have no basis for, so we can't depreciate that. If we're expensing out our expenses into raising, breeding livestock, this is why this is such an important category to those of us in the livestock business, is that if we have already expensed out everything that goes into the production into a breeding female, then we can't depreciate it over time. We've already, if we look back in history, we've actually expensed her out and him out, those bulls and the rams and that sort of thing, over the getting them from one point to the effective date of when they actually become the factory. Okay, so those ones, assets, the two examples that I would give that are really good for assets that have no basis are breeding livestock and gifts. Okay, here's some examples of those things that we would actually depreciate. All right, and you can meal around this slide a little bit and take a look at it, probably add to it and that sort of thing too. And here's where we do have purchased breeding livestock, because we begin with a basis. We purchased them. So what are the methods of depreciation? And it's almost just because it's not very sophisticated, it's kind of gone out of favor with many people. But actually, when I got started into business and I started talking to other business leaders and business people that were successful, it's one that's employed more than what you would think, because it is very, very simple. It's easy to perform, and that's called the straight line depreciation method. It's really easy to calculate. Of course, you could have a spreadsheet set up that actually did the calculation for it. Depreciation through a straight line method, every single year it's the same straight line. So year 1, 2, 3, 4, 5, or if it's a 15-year asset, every year it's the same. There's no complication to it at all. The annual depreciation is simply the purchase price minus the salvage value. I have that in parentheses so that we perform that mathematical operation first, and then we divide it by the years of useful life. It's a really, really simple, and many of you probably have used it, have heard of it, and maybe even calculated it. Okay, so we won't spend a lot of time on that. Part of the homework assignment will make sure that you know how to do that. Okay, so any questions on that, let me know. The straight line uses the actual purchase price. All right, it establishes the salvage value, whether there is one or not. And with some assets, and we were talking about this in class the other day, what is an asset that doesn't have a salvage value? Okay, now and one that comes to mind for me is fence. All right, it might have a 15-year, 20-year useful life, but then you might say, well, I can take it down to the salvage yard. I can go out to Wyoming Recycling and turn it in and that sort of thing. But the cost of tearing it out, plus, that's a negative, by the way, plus the what they'll give you for it is probably still going to be negative. Okay, so I'm going to say that salvage value, we can't give them a salvage value of negative, but I'm just saying that on an asset like that, we're probably not going to have too much of a salvage value, or none. Okay, so but most assets that we're going to employ within our business, technologically they might wear out, but they might be useful, and we can go ahead and go and sell them just like we would trade in our pickup or that sort of thing. Although never buy a used pickup from an outfitter or a rancher, because they've usually got most of the use out of it, right? So so useful life, this one I've vacillated on a little bit for management purposes. I want to give it the most accurate useful life that I can. I might look at the IRS tables that I have actually in this particular slideshow to get me as close as possible in a practical sense, so I don't have to be completely way off base when I go over and look at my numbers in a tax situation. So I might use them in that case if they apply. But for instance, the IRS allows you to depreciate a tractor in 3 years. I know lots of farmers and people that have tractors. Typically, they use them for 10, 15, 20 years, and many years longer than that in a lot of cases. So I'm going to probably fudge on those kinds of ones, even though the IRS lets me depreciate it in 3. And one of the reasons for that is that a lot of tractors, for instance, I mean, this is made for other businesses besides agriculture, are employed in other industries. And just think about a coal mine or you know, the mining industry itself. They probably are going to use up a tractor in 3 years. It's going to be wore out after probably running 20 to 24 hours a day for, you know, for just a couple of years. So, I mean, that's where you have to kind of do some manipulation on those useful lives compared to what the IRS allows you to do for management purposes. Because, I mean, for a tractor, I would say 7 to 10 years is not abnormal. Technology may be revolutionizing that. Maybe we need to actually upgrade our field or our asset base of that particular of implements and tractors so that it might deplete itself in 5 years. But you can make the call on that. It's a management decision-making thing, and then you can apply that over into the IRS schedules for what they allow. Okay, book value is the same thing as basis, as I was talking about before. Is how you determine that is your purchase price minus your accumulated depreciation. And okay, this is another one that I want your brain to, every time you see these kinds of things, this book value, it should say balance sheet. It goes posted on the balance sheet, reflected on the balance sheet. Okay, that's how we determine it. Depreciation in a double entry system also, just for a little added information, and those of you that are accounting wonks, depreciation is a contra asset. It means it's contra to a regular asset. It's opposite of a different asset, so it's actually a negative effect on your asset side of your balance sheet. It's a negative asset. So, and it's posted as a depreciation expense on the equity side so that it balances out in the double entry system when you're posting. Okay, maybe a little more information than you needed to know at this point. The next thing that we wanted to talk about, and I know this slide doesn't come out very well, you can take a look at it if you'd like. I just put this in here for information for you, but so it just shows the assets and what the IRS actually allows you for depreciation. Okay, the next type of depreciation that we would look at as far as managerial and something that's actually fairly close to what they allow you to do from an income tax depreciation method is called the declining balance depreciation. And this is actually a fairly easy type of depreciation method, but some of the pushback on using straight line is that, you know, people say, Todd, you know, when I drive that pickup off the lot, it's already depreciated $10,000. Okay, I lived in Oklahoma for a few years, so nothing against Oklahomans. I love them, and they're good people too. So anyway, your depreciation, it might be in your best interest on a managerial level to actually accelerate the depreciation from the front end. Means you can't take as much depreciation at the back end of a useful life of an asset, but we can actually use declining balance methods of depreciation. We use a factor of 1, 1.25, 1.5, and 2, which is, if you've heard of it before, it's called double declining balance, 1.5 declining balance, and so forth in that sort of depreciation descriptions. the higher the rate, the more accelerated the depreciation. And you need to actually perform some of these a few times in order to figure out which one might be applied to the right type of asset and useful life, okay? And that's what I hope that you'll actually gain an appreciation for when you start calculating these things. Okay, declining balance, couple of the rules that we have to follow. It does not use the salvage value to calculate the annual depreciation. Okay, so within the formula for the actual depreciation, we're not going to use salvage value. We're going to use it in the end, and I'll get to that. To the second rule, and that applies to what we were just getting at there. One cannot depreciate the asset where the book value, the basis, that is the purchase price minus the accumulated depreciation, is less than the salvage value. So we're going to deplete down to the salvage value. That is the lowest value the book value can fall to, is the salvage. Okay? It can't go below that. Quote, emphasis. Okay? So let me give you the calculations in declining balance, or using a declining balance or an accelerated version of the declining balance. In year one, we're going to take the rate, that's either 2, 1.5, 1.25, or 1, times the purchase price, and then we're going to divide it by the useful life. Okay? From there on, throughout its useful life, we're going to take that same rate times the remaining value. Okay? Remaining value is the book value at that time, and that is the purchase price minus the accumulated depreciation divided by the useful life for the rest of the lifetime of that asset. Okay, I'm going to give you an example. We've got an asset, like nice round numbers. I told this to my class too. If I see a set of books that has nice round numbers, I know that they're lying. Okay, that might be a little tough on some people, but I know that they're probably manipulating the numbers. But for example purposes, I really like real nice round numbers. If you have an asset of $10,000, that's what you purchased it for. You have a nice even number of $2,000 as the salvage value established in the beginning of the life of that particular asset, and you have said that it has a useful life in your business of 4 years, and you want to use a rate, a double declining balance of 2. This is how you calculate it. The first year, you would actually have a $5,000 depreciation on that particular item. Now, can anybody figure out on a straight line basis what that would be? I'll give you a couple of seconds. Okay, so on a straight line basis, we're going to take 10,000 minus the salvage is 8,000 divided by 4, and you would have depreciation of 2,000 per year until you get down to your salvage value. Alright, so that's the difference. We accelerate the depreciation at the beginning of that asset. Many assets we would use this for, or could use it for, because it would actually describe the value of the asset more accurately. Declining balance, remaining value is $5,000 for year 2, because we depreciated, we expensed out $5,000. So it was a $10,000 purchase price. We get a remaining value of $5,000. We still have a rate of 2, so we have 10,000 divided by 4. We get $2,500 for year 2, which would be the depreciation for that year. Now, if you're accumulating this in your head, we've had $5,000 worth of depreciation in year 1. We've had $2,500 of depreciation in year 2 for a total accumulated depreciation of 7,500. Okay, so we have a book value at the end of year 2 of 2,500. All right, now we're only in year 3. Now we take the double declining balance times the 2,500 remaining balance divided by 4, we get 1,250. Now that's a problem, because if we deplete, deteriorate, use up, expense that asset by 1,250, what happens? Our book value drops below the salvage value, and that was one of the rules we cannot do if we're using an accelerated depreciation method. Okay, so a salvage value on this asset is $2,000. We can only depreciate that asset another $500 in order to get it to the salvage value. So here's a little homework for you that I won't test you on. Well, I'll test you on the concepts, but actually for the useful life of this asset is using a double declining balance method the best method if you're going to have a useful life of 4 years. You might calculate this through using a 1.5, because that's going to decelerate the depreciation, but maybe give you enough kick in the beginning to actually see some true accuracy in your depreciation. That's what I would recommend you do. So, little homework for you to do. I'm not going to test you on it, but if you're interested, you might just do that. Okay? So, in this case, where this asset, I put this slideshow together before I asked you that question. So I'm going to take you through that, okay? So anyway, so in year 1, if we use a 1.5, we actually get, and this is another way of short-circuiting this calculation. Actually, if the calculation is the same if I just take my rate divided by my useful life times the remaining value, okay? And in this case, it's the rate of 1.5 divided by 4 equals 0.375, means that we're going to depreciate 37.5%, another way of saying that, of the value of that asset per year. You get 3,750. Now that might line up a little better with what I want to have happen within that asset as far as the depletion, using up of that expense per year. It's more than actually the straight line method would provide me, but less than the double declining balance. Okay. Let's go to year 2. But you employ the same calculations and take the rate 0.375, that's not going to change, times the remaining value. I get 2343 and a book value of 3906. Okay, now I want you to you should be able to just look at these numbers and say, well, let's see here, salvage value is $2,000, so I've got 1,906 and some change left to depreciate on this particular asset, okay, in order to get it down to the salvage. Okay, so in year 4, if I use that 0.375, I get depreciation of $1,464 and some change, and I get my book value to $2,441.41. Okay, now that's getting awful close, and we only have 1 more year of depreciation on this particular asset. Okay, so what are we going to do? We can do the calculation, but I can actually look at this right now and say, it's the last year that we're going to expense the depreciation on this particular asset, I know I'm going to use 441.41. My book value is going to come out to be $2,000. So that's the simplicity. Actually, a pretty simple concept when you want to accelerate the depreciation on an asset. So there you go. That's how you perform that depreciation. A good spreadsheet will do all this for you. At least, even if you have to do it in your head or in a calculator, it'll keep track of it and it'll be there next year or the next month next quarter, however often you keep track of this sort of thing. Okay? All right, well, that ought to get you going with the homework. We'll have a short quiz for this week too, and I wish you the best. I know this was kind of a long video, but we don't get to see each other, so I force my students in class to see me 3 times a week for 50 minutes. But you don't get to hear all the elk hunting stories and life lessons that I've had to go through either. So if you want to hear any of that sort of stuff, you're just going to have to call me. Take care.